If I look at the result yesterday, just focusing, it was a full year result, so let's just focus in on the second half. That's the new piece of information out there. What we really saw there is some moderate growth coming through in the EBITDA and cash flows in a pretty benign passenger growth environment. If we break up the business between commercial and aeronautical revenues, commercial, a bit over 50% of the revenues, look, some pretty good growth coming through there, and they've done some fairly clever deals within their property and retail portfolio. So, for example, with their duty-free tender that they've got, their duty-free contract, they've actually taken back 790, I think it is, square metres of retail area, and they're going to lease that out to 5 new boutique stores. For the remaining duty-free area, they're actually not losing any rent on the reduced amount of area. So the real sort of nice little kicker coming through there, that duty-free contract's been extended out to 2029. The property side of the business, that's actually seen a decent kick-up coming through in the second half, which when you annualise, drives through a nice little additional earner coming through. The parking's been one that's been sort of subject to modal shift as people are driving less and using the train. Parking actually held up, even though the number of car spaces available at the airport dropped by 20% on PCP. So some pretty good stuff coming through there. Aero, look, it was flat. A little bit surprising because we've had a little bit of passenger growth coming through. We have contracted price escalations on the international. Implies that domestic pricing came off a bit, and that could be partly to do with what's going on with on the Qantas side that we can't really quite see because of the contract details. OPEX came off 2% on an underlying basis. Debt costs are nudging lower. Look, they just issued some bonds recently. One of them was a 30-year sustainability bond. There's not too many corporates in Australia that can actually issue out 30 years, so pretty impressive stuff. Without a doubt, the biggest risk to this stock is the travel restrictions and the coronavirus impacting passengers. Look, we just don't know. Sydney Airport just does not know how this is going to play out, but so far they've likened it to SARS in 2003, and they highlighted that in 2003, in the worst months, international passengers actually dropped by 15 to 20%. Now, they were in the worst months. If we actually look at the whole of 2003, international passengers were only down 2%. So, you know, that basically shows the sort of the ability of the business to really rebound from some of these negative events. They weren't willing to quantify, you know, on some sort of per month basis what the impact could be, but they just continue to highlight just the strength of their business model, resilience of revenues, the cost out platform that they've got in there at the moment, and just that track record that I've shown you before over time when there's been numerous negative events hitting passenger levels, passenger numbers. Typically, it returns straight back to trend growth once those events have passed. What have I done to mine? Sorry, I should point out, because of that sort of lack of clarity on where things are going with the passenger numbers, they've delayed publishing their FY20 distribution guidance. That was a little bit disappointing. Where do I think things could play out? Well, look, I've run some numbers through my model. Look, I'm assuming international passengers are down 7% this year. I'm assuming domestic passengers are down 2%. It ends up being that even with the growth in the commercial side of the business and the cost out, you have EBITDA effectively being flat, cash flows being flat. And then what I'm assuming is you get a rebound to trend in 2021 and we're off again. So what does that mean? Well, I think they can support the 40-cent distribution that I've had out there previously. So fully expect them to come through later this year and sort of announce that. So what's that mean? It's yielding 4.8%. I think it can grow between sort of 3 to 4% over coming years. So look, investment view, what do I think about this? Well, look, to me, you make money out of Sydney Airport when a risk period passes and the share price rebounds. We've seen it numerous times, right? So there was a tax event a while back. There was the decision on the Western Sydney Airport. There was the Productivity Commission report. What was going to happen there? There was aeronautical repricing. Whenever those things happen, we saw Sydney and Transurban's share price disconnect. And then when those risk events passed, Sydney Airport's share price really recovered. Coronavirus will pass. This is a long life, high quality asset. Look, we may get the opportunity to buy this cheaper if they start to print some really negative traffic numbers over coming months. But to me, there's enough value in this stock at the moment. I'm sort of estimating a TSR of 15%. So very happy to have your clients start to accumulate this one now.